Tesla is ridiculously overpriced. I'm sure that the stock is going to crash at any time. And you know what? I'm going to short the Tesla stock. Yes, you heard me right. I'm going to short this bad boy. There we go. Short Tesla.
24 hours later.
Tesla is up by 10%. Makes no sense, but it's okay. I'm gonna wait.
3 days later.
Tesla is up by 50%. Come on guys, are you all stupid?
4 to 6 days later.
It's up by 10%. Stop going up.
Several days later.
200%. Please stop going up.
1 week later.
It's up by 500% now.
2 weeks later.
Daddy, are you making money for us? You know what, son? You always told me you love camping. Well, good news. Pack your stuff because from now on, we're going to live in a tent. I know short selling looks so appealing, that it looks so ridiculously easy. It seems to be the easiest way to make money in the planet. But certain things need to have a bit more perspective. So today we're going to see first of all, what is short selling and should you ever do short selling? Let's dive in. Before getting started, don't forget to hit the subscribe button down there and activate the notification bell to never miss a new video. And also, I would like to announce to you that I will host a webinar on January 27. More details in the link in the description below. So, short selling has always been very controversial, just like animal laboratories and cluster bombs. Politicians around the world have always wanted to ban short selling, and when the markets are very volatile, very unstable, short selling is temporarily banned. It's exactly what happened around March-April of 2020. Short selling was temporarily banned. But why don't we start by the beginning? What is short selling? Short selling is the act of betting against a certain stock. It means that you're going to make money when the stock goes down in value. It is the opposite operation of buying a stock, because when you buy a stock, obviously when it goes up, you make money. But here with short selling is the opposite. You make money when the stock goes down. And here I'm talking a lot about stocks, but it is also possible to short bonds, commodities, and other assets. But short selling, most of the time, regards only stocks. But wait, how do you do that? How is short selling possible? Short selling is possible because you borrow a stock from a certain person, you then sell the stock at the market price, then later, when the market price goes down, you buy again that stock and then you return it to its owner. Did you understand? No. Okay, don't worry. I know it's difficult to understand. It took me a while also to understand how short selling works. But I think you'll understand better if I take an example. Imagine investor A. Investor A thinks that the price of the Apple stock is going to go down in the near future. In other words, he's bearish on Apple. And he wants to make money when the Apple stock is going to go down. And now comes investor B. And he has a lot of Apple stocks and he doesn't want to sell them. He wants to hold onto them. And now investor A has a little idea. He thinks, hey, investor B has a lot of Apple stocks and he's sure he doesn't want to sell Apple stocks. So I'm going to borrow Apple stocks from investor B. Of course, investor B is not going to do that for free. So I'm going to give him an interest for borrowing Apple stocks. Once I have the Apple stocks, I will sell them on the market at the current market price, let's say $100. And that's what investor A does. He sells the Apple stocks at $100, the current market price, and then he keeps the $100. And now let's imagine that a couple of weeks later, the Apple stock went down to $50. Investor A is gonna buy the Apple stock at $50 and he's going to return the Apple stock to investor B. But remember, before that, investor A sold the Apple stock for $100 and he used only $50 to buy back the Apple stock. So in that case, he made a $50 profit. In that case, everybody's happy because investor A could make money and the investor B also made money because anyways, he didn't have the intention to sell Apple stock and he got an extra income from the interest that investor A paid to him. So now you know how short selling works. Now, let's review what are the advantages and the disadvantages of shorting stocks. So the obvious advantage of short selling is that you can make money when the stock goes down. And there's a second advantage that you may or may not find interesting, it depends on your point of view, is that you get extra cash. Because remember, investor A got $100 of cash without putting any cash out of his pocket. And some people use extra cash to buy stocks. Think about it. You can buy stocks with cash that is not yours, that you didn't put out of your pocket. In other words, with short selling, you can have leverage. In other words, buy stocks with money that is not yours. Some people love leverage and a lot of people hate leverage. So that is why I said it could be an advantage or disadvantage. Depends on your point of view. But that may not be very interesting to you. You clicked on this video because you wanted to know about all the disadvantages of short selling, right? So let's start the funny part. Let's talk about all the disadvantages of short selling. And believe me, there are quite a few. Disadvantage number 1. Short selling costs you money and time works against you when you're a short seller. Because remember, short selling is not free. You have to pay an interest to the person who lent you the stock. And the interest rate can be very high, and the interest is collected fairly often. That is why when you're a short seller, time works against you. Every single extra day that passes where the stock is still high, where your bet still didn't fulfilled, you're losing money. You have to pay interest over interests. The prediction that you made that a certain stock has to go down fairly quickly has to happen fairly quickly. I cannot short Apple stocks, for example, and wait for 2 years because I will already be bankrupt in 6 months because of all the interest I have to pay. Compare that with buying a stock where time works for me, not against me. All of that means that short selling by nature is very short term and it costs you money. And if you've been following me for a while, what it is when something takes money out of your pocket consistently, it is a liability. So that summarizes disadvantage number 1. Short selling is a liability. Disadvantage number 2. The losses when you're doing short selling are potentially unlimited. Think about it. If I buy an Apple stock for $100, my maximum loss is $100. If Apple goes bankrupt and my potential gains are unlimited, the Apple stock can go to 200, 500, 1000. It is completely unlimited. On the other hand, when you short Apple stocks, your maximum gain is only $100 if Apple goes bankrupt, but your losses are potentially unlimited. What happens if the Apple stock goes up to 150, 200, 300, $1,000? Your losses are infinite. So imagine if you put $10,000 in your trading account and that you invest $1,000 on a short sale and this short sale goes bad, it can potentially completely wipe you out, even though you didn't invest the $9,000 that were remaining. That is why shorting stocks is considered to be very risky. And it is because your potential losses are infinite and the odds of succeeding are very low because you have to be right in such a short time frame. Disadvantage number 3. The odds of success when you're doing short selling are very, very low. It's an accumulation of disadvantage number 1 and 2. Short selling by nature is short term, it costs you money, and your losses are potentially illimited. And here's the thing about stocks. Sometimes all of them go down, like it happened in 2020. Sometimes one stock in particular goes down and never goes up because the products have lost a lot of market share, it has become irrelevant, or they're going out of business. Just like what happened with Kodak for many, many years. The stock was going down, down, and down. But that is the exception to the rule, because long term, the majority of stocks, they go up. You just look at the charts, long term, stocks go up. And here's another problem. Markets are irrational. A stock can be crazily overvalued. It can be ridiculously overvalued. And you might be right, the stock is overvalued, but despite that fact, shorting an overvalued stock is still a bad idea. Because the markets can remain irrational for very long. They can remain irrational for weeks, months, even for years. There is an old saying that says that the market can remain irrational longer than what you can stay solvent. And what happened to our friend at the beginning of the video? Well, that's what happens to the majority of short sellers. Even when they are right, even when short sellers are right, the odds of succeeding are very low. Compare that to buying stocks. If you detected a great bargain, a superly undervalued stock, and you buy it, time works for you. If you're right, sooner or later, you're going to get rewarded for it. Because there are no pressure, no interest to pay, no unlimited losses. The very famous movie The Big Short shows that very well, because Michael Burry, the protagonist of the movie, almost goes bankrupt when he tries to short the real estate market in the US. He thought that the US real estate was going to crash in the early 2000s, and he had to wait up until 2008 until it happened. In the meantime, for several years, he had a lot of pressure because he had to pay such crazy amounts of interests. He was very close to being completely wiped out, and if the US real estate market would have stayed irrational for a little bit longer, for 3 extra months, for 6 extra months, he would have gone bankrupt. That's for sure. By the way, if you didn't watch the movie The Big Short, I highly recommend it. It is really good. So I think you got the point. Short selling is extremely risky, it has unlimited potential losses, and even when you're right, the odds of succeeding are very low. That is why I do not recommend shorting stocks to anybody. Quite the opposite. You should never short stocks. Okay, I got it. More than 90% of the time, shorting stocks is a very bad idea. But if the markets are very highly priced, very overpriced, and I know it's going to crash soon, what should I do? In that case, simply stay out of the market. Don't do anything. Stay on the sideline until everything comes crashing down, and when things come crashing down, you buy everything at the bargain price. It is a much better strategy than shorting the market. I would like also to tell you the time I made a big short. I remember it was in 2016 when Brexit happened. I had just opened an account on FX Pro. I had studied technical trading, chartism, and all that nonsense. But everybody was doing it, so I thought, hey, I'm going to do the same. I was really motivated. I thought I was going to make so much money so easily. I had shorted the British pound, but I shorted too late because right at the moment when I shorted, the British pound soared. And to make matters even worse, I was using leverage. Yes, I know, I was a dumb teenager. As a result, because of the leverage, the short, and the high interest payments I had to make on the short, I was completely wiped out. In a matter of hours, I lost everything I had on the account. I learned about the dangers of short selling and leverage the very hard way that day. But it was a valuable lesson nonetheless. That's it for this video about short selling. As always, I hope you enjoyed this video and learned something from it. If that is the case, a little thumbs up is always appreciated. Do not forget to hit the subscribe button and do not forget to register to my free webinar that will take place on January 27, 2022. I will see you very soon for our next episode. In the meantime, take care.